salary day. You're excited to hear that sweet notification sound and to read that lovely text.
फरहान, सैलरी आ गई। $35,000 पर CTC तो बाकी का कहाँ गया?
कट गया। पे स्लिप चेक कर, नीचे से चेक कर, नीचे से। ह्यूमन बिहेवियर के बारे में हमने उस दिन कुछ जाना। CTC कम हो तो दुख होता है, लेकिन CTC जितनी प्रॉमिस्ड हो उतनी भी ना मिले तो ज़्यादा दुख होता है। हम दुखी थे, फिर गुस्सा थे, इतने गुस्सा कि HR को मेल लिख डाला।
Farhan, Raju, let's have a cup of tea in my office.
HR का मेल हम पर एटम बॉम्ब की तरह गिरा। हिरोशिमा और नागासाकी में मातम छा गया।
Look at me, idiots. Pay attention. ये है तुम्हारी CTC, कॉस्ट टू कंपनी। अब इसमें से एक या 2 जीरो हटा दो, इससे कोई फर्क नहीं पड़ेगा, बिकॉज़ वो वैसे भी डेसिमल पॉइंट के बाद है। मगर इस 2 को हटा दो, that would worry a little. ये तुम्हारी बेसिक सैलरी है, और अगर यहाँ पे 3 ऐड कर दे और फिर 2 जीरो मिटा दे, तो ये तुम्हारा मंथली इन हैंड है। बिग रीजन टू वरी। टाइप करना आता है? प्लीज टाइप। डियर सर, it is my painful duty to inform you that your son is a gullible and delete karo, go back. Your son, Mr. Raju Rastogi, is a gullible employee. Notice board पे लिखूं? You also type.
नो सर।
सर मैं सोल लर्निंग मेंबर हूँ सर।
ये बात ऑफर लेटर साइन करने से पहले सोचनी चाहिए थी। मेरी बात मानो, अपना YouTube फीड चेंज करो, फुल डिस्क्लोजर को सब्सक्राइब करो। हायरिंग सीजन आ रहा है, अवेयर रहोगे तो अननेसेसरीली कटवाओगे नहीं अपनी सैलरी।
It's salary day and you don't want to be in their shoes on salary day, so I'm here to clear the confusion. My name is Lavina Kamath and here's the full disclosure. We're very excited to be a part of Zerodha's media network. Together, Zerodha and we will bring you well-researched videos on careers, different industries, and the evolving job market of India. This was the offer letter Raju signed, and this was the salary that he received. So his shock was justified when he read his salary slip, because in his head, he should have received 2 lakhs per month from his 25 lakh CTC. But what he ended up with was just 35,430 rupees or 4.75 lakhs per annum. The rest of his CTC, 1 lakh is retention bonus, which he would get after a year. 1.25 lakhs is performance bonus, also subject to his performance and the company's performance. So let me just say he's not receiving the full 1.25 lakh amount, if at all he receives anything. Then 1 lakh of gratuity that he can encash only after 5 years, that was also included in his CTC. And finally, a term insurance cover of 17 lakhs also mentioned in the CTC. And he forgot to account for tax deductions. Similar was the case with Farhan. Only 8 lakhs from his supposed 20 lakh package was of any tangible value. The remaining 60% were in ESOPs. Will he ever see that money? But he will pay capital gains tax even before he gets any money from the stocks.
It's crazy how much of this is not taught in traditional education. Things like structuring your salary for tax benefits, negotiating your CTC smartly, or even making career decisions based on financial impact. But imagine if business education actually covered real-world scenarios like this. Our partners for today's video, Scalar School of Business, do exactly this through their 18-month full-time PG program in management and technology based in Bangalore, India's startup hub. The program is designed by industry leaders from Uber, Myntra, and McKinsey to equip students with business skills relevant to today's fast-moving economy. The curriculum mirrors real-world scenarios through company-sourced projects which are led and evaluated by the CEOs who lead them. Imagine pitching a GTM strategy to Uber India's CEO and getting feedback directly from him. This practical experience is combined with a strong academic foundation featuring faculty from IIM A, B, and C, along with industry leaders who have built successful businesses themselves. For example, their product management course is taught by the ex-product head at Coinbase and InMobi. Further, with over a decade of experience, Scalar has access to 1,200 plus active industry partners. These include major companies like Google, Amazon, Bain Capital, Deloitte, and Zomato. The median salary of their online programs has been 25 LPA, with one student even bagging a package of 1.7 crores. These numbers have been verified by B2K Analytics, the same firm that verifies IIM Ahmedabad's placement reports. Their next batch launches this August in Bangalore. Applications are open and you can receive scholarships of up to 100%. So apply through the link in the description and also check the pinned comment below. Now back to the video.
The numbers you see on your offer letter and what you finally see on your salary slip are very different. The truth is, it is confusing. Did you know that CTC is not even a legal term, and yet all you hear about is the CTC? CTC manipulation aside, even your salary slip has too many elements to make sense out of. There's fixed pay, there's variable pay. Then there's your basic pay, there's HRA, DA, LTA, and whatnot. There's professional tax, there's TDS, EPF, PPF. It goes on.
यार तुम एचआर वाले क्यूट तो होते हो, पर तुम्हारी ये डीए, एचआरए, एलटीए ऐसा लगता है जैसे कोई मिसाइल्स है।
आज एचआर ने 10% टीडीएस लगा दिया, 200 लोग डिसअपॉइंट हुए, 400 लोग कंफ्यूज हो गए।
But most of the time, the disappointment and confusion you get after reading the salary slip is the result of you not being aware of how it all works. If you see your salary slip, it is complicated by design, but some of it is actually there to help you through tax exemptions, rebates, and allowances that you can claim if you know how to. So let me try to simplify it all for you. The first thing you need to realize is that your employment is a personal contract between you and your employer. Once you sign the offer letter, you agree to the terms of employment, including the salary structure. So you need to be careful before signing it. So when your salary is disbursed, there are three players who are very interested in the amount and its breakup. First, obviously being you who's going to receive that amount. The second being the company who's going to disburse that amount. And the third, the government monitoring every transaction between you and the company. The company wants to maximize the value of what they spend on you, ensuring more of it reaches you directly rather than getting deducted as taxes. You would want the same thing, while the government would want to get as much funds as possible for them.
सैलरी स्लिप दिखाइए, नहीं तो हम आपके ऊपर केस फाइल कर देंगे।
Your salary slip has two major sections: earnings that you get and deductions that the government gets, or you get just at a later date. But the company pays for both in the present. Therefore, CTC. Cost to the company, whether you receive it directly or not. From the company's point of view, the number they care about is CTC. When you look at the salary slip, you as the employee are only concerned with the earnings part, which has all these headings like basic pay, HRA, DA, all contributing to the amount you can finally take home. There are certain headings which will be mentioned in the offer letter, but you may not see them directly or every month, like your bonuses and allowances. Take special allowance for example. It will be part of your CTC, but it's actually a reimbursed cost, which means the company won't give it to you directly, but you can spend your money on books, clothing, and so on and be reimbursed for it. There are some caveats to all these allowances, but I will come to that in a bit. Then comes the deductions part. Everything you earn on this column is subject to deductions and taxations on this column. Most young professionals forget about it and then they feel disappointed. Like your basic pay, which is 100% taxable at the rate of your current slab. The government receives this amount.
Thank you.
You lose 5 to 10% of your salary to taxes directly, regardless of the slab you're in, to something called as TDS, tax deducted at source. This is the tax your employer pays on your behalf in advance, and it helps spread your tax liability throughout the year instead of a lump sum payment. The logic of the government is to tax you upfront, and if you're eligible for any rebates, exemptions, you can claim them while filing for your taxes. The TDS rates look like this.
आपने डिपार्टमेंट को वो चीज़ दी जिसकी हमें सख्त ज़रूरत है।
फैक्ट्स।
टैक्स।
But not all companies are going to have a TDS structure in place, and it depends on the kind of contract they've drawn with you. Many smaller companies prefer to draw consultant contracts instead of employee contracts because this helps them to save on tax and other necessary costs like the EPF. For the larger companies or corporates, it's required by law to have an EPF system in place. EPF, or Employees Provident Fund, is deducted by the employer at the time of payday. 12% of your basic pay is deducted from your payment, and your employer contributes the same amount into a provident fund that you can redeem later under specific conditions. You can increase your PF contributions to 100%, but the company obviously is required to contribute only 12%. The company, though, is not required to implement EPF if they have less than 20 employees or where all employees earn more than 15,000 rupees per month. Remember the consultant contracts? They come into play here. Many startups draw out consultant contracts to keep the employee count below 20 and thus saving themselves some cash.
आपने मुझे बुलाया सर? कौन हो तुम? एम्प्लॉई? परमानेंट हूँ सर। Congratulations. EPF काटो।
चलो।
EPF is a dying concept in today's time, but some companies still continue to deduct it. Many don't. The company that has hired you is also a business at the end of it. They would like to spend mindfully on the employee to remain profitable, but at the same time, they would also want most of what they're spending on you to reach you and not be intercepted in between.
CTC होता सबका हाई है। इन हैंड सब छुपा के रखते हैं, डिक्लेयर करता कोई नहीं।
Anyways, this aspect of the CTC manipulation that happens across the board is to you and the company's benefits, like structuring the company such that you can dodge the EPF mandates and the tax liabilities. Not that there's anything wrong with this, these are not loopholes but rules the government has created themselves. For example, because your HRA, LTA and such are also exempt from taxes, a big part of your salary is adjusted there, so you don't have to pay taxes on your entire in-hand, just your basic pay. But what about the manipulation these guys went through?
ESOPs.
Who's benefiting from that manipulation?
संडे मॉर्निंग को मेरे ESOPs वेस्ट हुए थे। मंडे मॉर्निंग को HR बुद्धे ने अपने ऑप्शंस एक्सरसाइज करके खुद को करोड़पति बनाया था, तो सोचो कितनी दैट नॉनसेंस। मैं आपको ESOPs दे सकता हूँ, कैश कंपोनेंट नहीं।
Well, CTC also serves as a branding tool for the company. CTC is the figure that attracts talent, market perception, and does branding. The higher the offered CTC, the better their company looks. You also feel better about yourself. And when you tell your parents the package you've received, they get the right to brag about you to a Sharma ji. And it's in everyone's interest to continue to play along. Because even if you said your real salary now...
मैं आपको ESOPs दे सकता हूँ, कैश कंपोनेंट नहीं।
सर, अब्बा नहीं मानेंगे।
So insurance covers and ESOPs become a part of your CTC, and there's nothing you can do at that point. Technically, employers are not supposed to include insurance coverage, gratuity or ESOPs in the offer letter, but they do.
Everything is fair in love and business, and this is business.
But it's still very confusing.
I know all of this is still very confusing. Till now, I was just introducing the players, the rules, and the game. But now I'm going to share some free advice with you. The info you need to maximize your earnings, minimize your taxes, and how to dodge seeming traps. So start taking notes.
All is well. All is well.
Here's what you need to know before signing the offer letter. The type of contract that you and your employer are getting into. if you're joining an MNC, most likely it's going to be an employment contract like usual. But if it's a tiny startup, it could very well be a consultant contract. The law treats employees and contractors very differently, and the employer does not have as many obligations with a consultant as with an employee. It's tough to know from the offer letter and the terms of agreement what the difference is, especially if you're just starting out. But one thing you can ask to check is if you're going to get taxed at 10% or as per your income slab. If it's flat 10%, then you might be a consultant and as such can also be terminated more easily. Next,
ESOPs.
Understand your salary slip thoroughly and check how it is structured. Basic pay is the core component of your salary structure that serves as the base for calculating other allowances and benefits. It is 100% taxable and is usually 35 to 50% of your CTC. If you're applying for a loan, your basic pay will be referred to for eligibility. Next is your house rent allowance, HRA, that some companies like MNCs provide for you to pay for accommodation costs. You can claim tax exemptions on this on the lowest of these amounts. 50% of your basic pay if you live in a metro city, 40% of your basic pay if you live in a non-metro, or the actuals of rent paid minus 10% of your basic salary. So if your basic pay is 50,000 per month in Bangalore, the HRA decided by the company is 20,000 and the actual rent you pay comes to 25,000, you can get 20,000 exempted from tax. Then comes dearness allowance, DA. DA started as a cost of living adjustment paid to mainly government employees, and some legacy private sector companies of the time also started including it into their structure. This was to offset effects of inflation, as back then appraisals were not a regular affair. Over time, it has lost its utility, but some companies continue to include it. The current DA rate stands at 46% of basic pay, but it is 100% taxable. The private sector is not required to include DA as part of their pay, but they sometimes include it in the basic pay itself. Ask your HR about this. Some companies will usually keep a separate heading for conveyance allowance. The amount can be what the company deems fit, but 1,600 rupees per month or 19,200 rupees per year is exempt from tax. The best part, you don't actually need to provide bills or proof for this amount. Any amount over and above 1,600 will be taxed at the normal rate. Then there is leave travel allowance, LTA, for travel within India with your spouse, children and dependent parents. Only if you travel by economy class airfare or first class train or below. You can only claim the benefits for a maximum of 2 journeys in a block of 4 calendar years, and it's limited to transportation costs, not hotels. Do ask your HR if your company provides this. They may not and they're not liable to, but if they do, make sure you avail the tax exemption. Pointers to keep in mind: you must actually travel to claim the benefit. If you don't, the LTA amount becomes fully taxable. You need to submit tickets or your boarding passes as proof, and road travel claims usually need fuel bills and toll receipts. Next,
ESOPs.
medical allowance. This is different from the insurance cover the company buys for you, and that is sometimes unethically added to your CTC. Your medical allowance is the amount kept aside for your medical needs. This is also exempt from tax up to 15,000 rupees per year or 1,250 rupees per month. Some companies add it straight to your payslip, or some reimburse it later on your actuals and bills. If your company pays you that amount directly, then you have the flexibility to spend it on anything. But then it is taxable. And lastly, there is special allowance that companies provide to balance your tax implications. What falls into this category is for the companies to decide, but this bracket is also tax exempt in very specific cases, like the allowance must be necessary or required for the employee's job, and you have to maintain proper documentation for the same. For example, if your employer tells the government that for my employee to be fully productive to the company, he requires books, academic papers, specific clothing, food, conveyance charges, or a helper, then the amount they so provide can be exempt from tax, because the government does not see them as personal spends anymore. So let's say your employer provides you a books allowance for 5,000 rupees. You buy books for 4,000 through the year and save the bills. Now, when you produce them to the company, and suppose you're in the 10% income slab rate, you will get 4,900 from it at the end of the year. 4,000 tax-free and 900 out of the remaining 1,000 with tax already cut. Now this 1,000 goes out of the allowance bracket and you can spend it on anything, but make sure you utilize the full amount because the company might not remind you upfront. The allowance exemptions have also recently been modified, so go through them properly. Let's talk about the components of CTC that might not be a part of your salary slip. Components that you will see only once a year, or in some cases after 5 years, or in some cases never.
Like ESOPs.
Like your performance bonus. You will receive your performance bonus once a year when you meet specific criteria or KRAs or KPIs, and sometimes the company's performance also. There's no fixed rule to this, but most companies will keep their performance bonus in between 7 to 15%. It is taxable and it's rare for any company to disburse the full amount. Then there's the retention bonus that you may get 2 or 3 or 5 years after you've been with your employer. So again, you're not going to receive it every month, and if you choose to leave before the stipulated period, the amount goes bust. Similar is the case with joining bonus. You may receive it upfront, but if you choose to quit before 1 or 2 years or whatever the company has stipulated, you're liable to pay back that amount. That was all about your earnings from your employer. Now onto the deductions. Every earning professional must pay a professional tax regardless of their employment type. This is a type of state government tax and every state has different rules. Like Kerala requires this tax once every 6 months, while most others deduct it monthly or annually. As of 2025, only 22 states deduct a professional tax. Then there is TDS, tax deducted at source, like I've already mentioned. If you're a consultant, you will pay TDS at the rate of 10%, otherwise you'll pay it at your income slab. One thing to note here is that your employer will predict your tax liability as per your income slab and pay it to the government. In that case, it is your responsibility to file your returns on the excess TDS. Always keep track of TDS in your Form 26AS and verify TDS matches your actual tax liability. If your company has not implemented TDS, in some cases, you may actually be asked to pay the difference to the government directly, so just file your returns anyway. Then there are smaller deductions like cess, which is the tax you pay on the tax you've paid at 4%. An ancient form of retention bonus is gratuity, which the company actually deducts from you first to give you after 5 years. Gratuity as a concept is losing its popularity, but if your company offers it, do make use of it because this fund is exempt from tax up to 20 lakhs. This amount is deducted at 4.8% of your yearly basic pay or half a month of your basic pay for every year you've worked with them.
ESOPs? Yes.
And lastly, the ESOPs. Employee stock options that the companies sell to you unsuspecting folks that have made multiple people rich beyond their wildest dreams. And the final component that can inflate your CTC by absurd amounts. But there is a cost. When a company offers you ESOPs, they're not stocks in your bank account. They're options to buy stocks in the future at a predetermined price. Suppose your startup offers you 10,000 shares at 100 rupees each. They're offering you the option to buy 10 lakh worth of shares in the future. In the meantime, the value of the stock can go up or down, or if your startup is pre-IPO, then your ESOPs are essentially a piece of paper. So it is very, very risky, especially if your ESOPs are not coming from Google or Amazon, but Chhaganlal Sons Limited Incorporated. When a company offers you ESOPs, there is a whole process before you actually see any money. First is the cliff period, the first year of your employment with the company. If you leave before completing 1 year, you get absolutely nothing. No ESOPs, no shares, nothing. This is designed because the company also wants to ensure that you are committed to the company. Then the vesting period starts where the shares are slowly transferred to you, typically over 4 years. Now, some companies will vest 25% shares each year, or some like Amazon vest 10% in the first year, then 20, 30 and 40% in the last year, essentially backloading the transfer. Some like Google vest a big amount like 35 to 50% in the first year. You can actually ask for your amount to be vested monthly after your first year so that you don't lose a lot if you choose to leave after 2 years and 11 months. But even after the shares are vested, it doesn't mean you're rich immediately. You still have to exercise those options to transfer to your account at a predetermined strike price. Each company defines their exercise period differently. It could be 7 to 10 years from the grant date while you're employed or 90 days post termination of your employment. Regardless, understand that the money is waiting in the future for you. Because if you're a pre-IPO startup, you don't know when the company would go public or when the next round of funding would happen for you to offload your shares. There's liquidity preference also assigned, which means even at a funding round, you may not be able to encash those shares because someone with a higher liquidity preference could unload their shares first and exhaust the funds in that round. And what's worse, as soon as you exercise your shares to your account, you have to pay a capital gains tax of 30% on it. You may not have sold it yet and got any cash, but you still have to pay the government tax on it. That's just how our government works. So when you're getting an ESOP heavy offer, always remember to ask these questions. What is the cliff period and the vesting period? What is the strike price? What is the exercise window after leaving? When and how can I actually sell these shares? Remember, ESOPs are like lottery tickets. They've made some people crore-patis while others end up paying taxes on shares they can never sell. Always prioritize base salary and real benefits over ESOP promises, especially in early stage startups. Your ESOP to in-hand component ratio should never be more than 60% of your salary. So that was it. Now you know what to do the next time before accepting an offer. One final free advice. Never run after those lofty CTCs. Cash. Chase actual tangible cash. And money would come to you.
ओए, रैंचो का है?
My name is Lavina Kamath and this was your full disclosure.